Let's get more now from Ohsung Kwon, Chief Equity Strategist at Wells Fargo. It's good to have you join us. Thanks so much.
Thanks for having me.
So we've seen this kind of rapid shift in market sentiment when it comes to those hyperscalers. What are some of the factors behind that shift, do you think?
Yeah, I think it's really the capex, the size of capex that they have to invest in, because I think this is really on arms race that they kind of have to invest to not get disrupted. Every single quarter since 2024, there was a step-up increase in hyperscalers' consensus capex numbers, and we saw the same thing so far this year, compared to where capex numbers were for 2026 at the beginning of the year. It rose by about $120 billion. So I think that's going to be the trend going forward as well. And their return on incremental invested capital is going to be similar to the S&P 500. All the free cash flow metrics are actually going to be below that of the rest of the index. So yet they're still trading at a premium versus the rest of the index. So I think there's still more downside and cautiousness around hyperscalers overall.
And we've seen Bloomberg reporting today that Alphabet's bond sale drew over $100 billion worth of demand. Like, I'm wondering what that tells you when you see a company as big as Google still kind of feeling the need to tap that debt market.
Yeah, I mean, for those guys, it's actually a lot cheaper to debt finance than equity finance. And I think that trend is likely to continue. Back in Q4, we saw the big four companies raising $100 billion in debt. And I think that's going to be the case going forward in 2026 as well. They're going to continue to issue debt because it's cheaper, and they're going to continue to invest in capex for AI. If you look at how much capex has been funded with that so far, it's been only about 2-3% that's been funded with that, whereas the prior investment cycles during shale and during telecom, the number was 15% and 30% respectively. So we are still in the early innings of this leverage-led capex cycle.
Okay, so you're obviously cautious on the outlook of the Mag 7. We touched on this off the top, but are there sectors that you think could still be lucrative for investors who want to still be in that AI kind of trading game?
Yeah, I mean, within the AI complex, we still like semis. Capex is going higher, and you want to own the picks and shovels that are going to benefit from ever-increasing AI capex. The other non-AI sector, we are bullish as well. We are starting to see some green shoots in non-AI, whether it be energy, materials, some of the commodity sectors, as well as short-cycle industrials that have really been sluggish for the past 3 years. We think we are finally in this reflation cycle for the first time in 3 years, and I think it's going to continue. The PMI data that we saw earlier this month, I think that was essentially the beginning of the PMI upcycle going forward. Post the tax return season, when people are going to get a lot more money this year versus the last year, that's going to translate into higher demand for goods. Also, inventory levels are pretty depleted. And back in January, we saw the sharpest inventory rebound in 3 years. So we're finally in this restocking cycle after 3 years of destocking. And those things really point to continuation of this PMI upcycle.
When we're talking about the software sector, I mean, we saw some interesting things happening in recent weeks when Anthropic released their AI tool, and there was that sharp sell-off. A lot of analysts saying that was kind of overdone for the software sector. But I'm wondering, like, in the long run, do you think what we're seeing with AI is going to render software stocks and companies kind of obsolete?
Yeah, I mean, I think there are going to be software companies that are going to be disrupted by AI. I mean, this is kind of a natural cadence. When new technology comes out, there are going to be companies that get disrupted. What the market was doing over the past week or two was that it shot first and is going to ask questions later. It basically sold all software stocks as a group, and basically said that all software stocks are going to be disrupted by AI, which I don't think is the case. There are going to be companies that actually benefit from AI as well. Those, infrastructure software or those that are more consumption-based model softwares. I think those companies, it might be a great buying opportunity. Also, based on our newly launched systematic sector strategy, software actually ranks #1. Because their sentiment is at the rock bottom and their earnings cycle is still pretty healthy. Back in Q4, software companies actually posted 25% EPS growth year over year. it was the strongest EPS growth in 2.5 years, and they beat consensus by 5%. So the earnings cycle itself, fundamentals are still very strong. It wasn't really anything to do with fundamentals today. It was expectation that those fundamentals are going to get disrupted, which I don't think will be the case across the board. There are going to be winners within software as well.
Interesting. I guess we'll have to wait and see who those winners are. In terms of the markets, like going back to the markets as a whole, something else that's been kind of moving them one way or another this year so far is when Donald Trump announced his pick for the next Fed chair, Kevin Warsh. I'm wondering what your opinion on Warsh is in terms of how he could change how the markets are moving.
Yeah, I mean, I think the market got a little too bearish on the announcement on Friday, 2 weeks ago, I think. Yeah, a couple of weeks ago.
It's hard to tell at this point.
Yeah, I know it's been too busy, but you know, his hawkish view on the balance sheet was really the thing that the market was concerned about. The issue with that theory is that yes, he might be bearish on the balance sheet, but the Fed is still going to be purchasing $40 billion for the next few months, and even after he joins in May, I think it's going to be hard for him to immediately start to shrink its balance sheet because liquidity is still very tight. And I mean, that's what the market is telling us. The liquidity was really tight back in Q4 last year. And that's why the Fed decided to inject balance sheet or inject liquidity. And with that, we started seeing liquidity improving in the first half of January. And then in the second half of January, we started seeing liquidity draining again because of the tax seasonality. Looking ahead, our view is that our liquidity indicator, which has been a leading indicator of the S&P's multiples, that's likely to trigger a buy signal by the end of May. And what that means is, historically, when the buy signal triggered, the S&P 500 rose 100% of the time over the next 6 months, rising by about 13% on average. So there will be a very, very strong buy signal that we're going to get, regardless of what Warsh does, what Warsh ends up doing when he becomes the Fed chair. We are probably going to see that liquidity upcycle over the next few months, and I think that'll be very bullish for the market.
Interesting. Okay, we'll leave it there. Ohsung Kwon, Chief Equity Strategist at Wells Fargo. Appreciate your time. Thanks so much.